The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
Hello, everybody. Welcome to another episode of the Crazy Wealthy Podcast, the Fix It Friday edition. Thanks again for tuning in. Today, I'm going to talk to you about what I call the investment public's obsession with the Standard & Poor's 500 index, particularly the obsession involved with their desire to consistently outperform that index with their own investment portfolio or the manager's mutual funds that they choose to invest in.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
So, first thing I want to address is, where does this obsession come from? Why is it that everybody wants to know, how am I doing relative to the Standard & Poor's 500 index? So there are a couple of answers, but the big one is that I want to focus on is that in the 1970s, what was only available before then to institutional investors and pension-type investors was the availability to hire money managers. And when that became available to individual investors, the protocol that was used to measure the performance of these various money managers was adopted the same way that it was used by the pension managers and the institutional managers. So what they always did, those pension funds and institutional funds, is they would every quarter meet with the various money managers that they hired, and they would look at how each of the managers was doing relative to their respective benchmark, a random benchmark. Let's just call it the S&P 500 for managers who were investing in large U.S. companies. And then the pension fund would make a decision. Do we keep this manager or do we fire them based on whether or not they happen to be outperforming the random benchmark? So the first thing I say is, in the 70s, when the availability of broadly became recognized by individual investors to hire these types of managers, they were also then put into this protocol of every quarter I'm going to look at my portfolio and see how they're doing. So take a step back. The first thing is, there is no statistical evidence for the persistence of performance, meaning no one can consistently or has been shown to be able to consistently outperform any random benchmark. In this case, we're talking about the S&P 500. And so trying to do that takes people off the main goal of investing. And the main goal of investing starts with the first word that I said, goal. You have to establish your goals, then you have to establish a plan to meet the goals, and then you have to choose investments whose historical returns would have helped you have that plan come to fruition in the time allotted. And without taking those three steps, success as an investor is almost always elusive. And so what we want to do is say, how do I then measure my success? If I'm not looking at the Standard & Poor's 500 index and seeing how my investments do relative to that, what's a good way for me to measure it? So with that, I'm going to actually read from you a little paragraph or two that was written in April of 2021 by my mentor, Nick Murray. And what he said is, every once in a while, it's useful to step back from the permanent chaos of political, economic, and market events and ask ourselves the fundamental questions. What am I investing for, and how will I know whether I'm succeeding or not? How indeed does one even measure investment success? He then says the answers will be found not in today's headlines, and certainly not by attempting to predict tomorrow's, nor will they be a function of whether the market's next 20% move is up or down. The answers you're looking for can only be discovered by the light of your own personal financial situation. In practice, they'll depend on whether or not you're following in exactly this order the three fundamental steps to a genuinely successful lifetime of investing: goals, plan, and portfolio. He then says, This may be somewhat startling to investors who think successful investing is a function of whether or not their portfolio is outperforming some benchmark or getting in and out of the market opportunely. Considered properly, all portfolio issues are subordinate to the two vastly more important questions. One, have you set specific goals? And two, do you have a specific plan for achieving those goals and the time allotted? For most of us, that'll be our planned retirement date. The great thing about this is the realization that the most important variables in investment success are within your control, as opposed to economic and market variables, which are beyond your control. So the sum of what I just said, with the conclusion is, the only relevant benchmark for any investor who wants to succeed over multi-decades is their plan. And the plan is actually the medium through which the advisor and the client relate to each other. So after 2 or 3 years, we can look at the plan and say, how close or far am I from where the plan objective says I should be today? And based on that, what move should I be making? The move should only be made in relation to the plan, never in relation to responding to current events, short-term market fluctuations, or anything other than life events changing. So once we understand that the plan should be our benchmark, let's take a look at not only the futility of looking at the portfolio often, particularly during declining or tumultuous periods. It's not just futile to look at the portfolio, it's actually destructive. Because when we look, if we see something good, we get a dopamine rush. So we say, okay, let me go out and buy that new Bentley now because I made so much money this month. Or if we see something bad, it ignites our loss aversion bias, which is where we dislike the pain of a loss 2 times more than the pleasure of a gain is felt pleasurable. And so we'll start to do things like sell our investments. So we want to, in order to reduce the short-term pain. And that will likely be fatal to our long-term objectives being met. So as an example, I took a look at the time period from the pandemic decline, meaning 2020 when the pandemic rolled in. February 19th, the market was at an all-time high. And from February 19th to about March 22nd, the market went down a record 34% in 33 days. 5 months later, in August of 2020, it had recovered fully the 34% decline. Now, I can promise you that investors who were looking every day or every week at their portfolio, it's kind of like watching the water to see if you can get it to boil faster. They did not see their portfolio recover more quickly than the people who didn't look at the portfolio at all for the 5 months or so between March and August. They all recovered the same way. But worse, the people who were looking frequently, daily or weekly, most likely succumbed to the biases that the frequent looking ignited, and they changed their portfolio in a very detrimental way and made a move from which they might never recover. Their retirement or their wealth could never recover from. So as we sit here today, the market has gone from where it was in February of that year, about 3,200, to almost doubling, about 6,300, 5 years later. There were a total of about 1,950 or 60 days in that period, and people who didn't look at all and just let their portfolio, if they were in the S&P 500 as an example, do what it does, compound, uninterrupted, they saw their portfolio almost double. Those who went in and out in response to looking every quarter or every week or every month, most of them have much worse results. So in summary, please don't think that you should be looking at the S&P 500 as your benchmark. Your plan should be a benchmark. If you're in a portfolio of index funds, which is what we recommend to diversify, it should be index funds, but not only the Standard & Poor's 500. From 2000 to 2010, the Standard & Poor's 500 lost 30%. If somebody outperformed it and only lost 20, that did not solve their problem if they needed to take 4% a year out of their portfolio. So outperforming the benchmark is completely irrelevant. It's staying diversified and capturing the long-term compounding in a portfolio and increasing your odds of doing that by not looking too frequently and measuring your success against a random benchmark that, as John Bogle said, he never met anyone who could consistently outperform the S&P 500. He said, in fact, I've never met anyone who has met anyone who could do it. So on that, thanks again for joining us. You can catch us on all your favorite podcast venues and on crazywealthypodcast.com and our website, fusionfamilywealth.com.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.